So this is chapter 19, part 3. We're just finishing up by looking at an example of joint cost allocation. So we're going to look at two different methods. The two methods that you'll be responsible for. The first one, out of the four methods, the only two that you'll be responsible for is one, the weighted average method. And the second one would be the market value at split-off method. So the second and third methods out of the four methods. So let's take a look at an example here. We have three products, product A, B, and C. We have a joint cost of $100,000. So that $100,000 is processing all three of those products before we can really split them apart and know which cost can be directly assignable to them. So that 100,000 is before we're able to do that. So products A and B are going to be weighted 2 times more than C. So for complexity purposes, they must take twice as long, or involve twice the work, or involve twice the complexity. For whatever reason, they're weighted as twice as difficult compared to C. The pure physical quantities of A are 100, B 200, and C 200. And for purposes of the selling or the market value at split off, so the selling price at split off, A is $20, B is $30, and C is $10. All right, so I'm going to do both of these actually on the same grid that I've set up. I'm going to do the first line, or the black line, is going to be the weighted average method, and the second line is going to be the, or blue line, is going to be the market value at split off. So even if you have different issues with colors, let's say, the first line is going to be the weighted average. The second line is going to be the market value at split off method. Okay, so product A, the split off quantity. So we'll just drop in the quantities. They're going to be the same for both methods, but quantity A would be 100. Quantity B is 200, and quantity C is 200. We have the weight factor. So like we said, for some reason A and B are weighted twice as difficult as C. So we're going to go 2, 2 to 1. Okay, so that's our ratio, 2 to 1. Both of those being twice as difficult as C. So we're going to basically extend that out. So our total weight would be, we're going to multiply those two together. So we're going to have 200. We're going to have 400. And we're going to have 200. Okay, that's going to give us a total of 800. So we're going to calculate a percentage. So we're going to calculate the percentage of the weight. So 200 divided by 800, that's going to be 1/4, or 25%. 400 out of the 800, that's going to be 50%. And these are just the column right before this. And then again, 200 out of the 800 is 25%. So that's the proportion of the total weight for each one to the total. Of course, our joint costs are 100,000. So it's not going to change for each one of these. And so joint cost allocation then for the first one would be the percent total times the joint cost total. So that's going to get 25% of the total, or 25,000. Product B is going to get 50%, or 50,000. And product C is going to get 25%, or 25,000. So fairly simple. I think the key here is the weighting factor, multiplying that by the pure quantity at the split off to come up with a total weighted amount, a weighted quantity, and then we're just calculating the proportion of that times the total joint costs that we're going to split among the products. Okay, so that's weighted average method. So the other method we're going to use to allocate joint costs, and I'll put it here, this will be the second method, and that's the market value at split off. So whatever the market value is at the split off, that's the proportion we're going to use. And again, that is all weighted based on the physical quantities. So instead of the weight factor, what I'm going to do is use the market value here. And I'll circle that down below so it's clear that that's what that is. So the market value for A, we said up here was $20. And the market value for B was $30. And the market value for C was $10. So if we multiply that by the quantity, our total weight would be 2,000. Here, 200 units times $30 selling price would be 6,000. Actually, let me circle this because all our numbers that we're circling relate to the market value method. And here, 200 units times $10 would be 2,000. Okay. And if we add those up, we get 10,000. Nice round number. It's almost as if I made these numbers up myself. All right, so what we're going to do is take the proportion of those numbers to the total. So in other words, here 2,000 divided by 10,000, so 2/10 would be 20%. 6,000 to 10,000 would be 60%. And again, 2 to 10, 2/10 would be 20%. And again, those should all add up to 100%. I think that's pretty clear. Again, times the joint cost. So that's how we're going to split up the joint cost of 100,000. And so in this particular case, 20% would go to A, or 20,000. 60% or 60,000 would go to B, product B. And 20% or 20,000 would go to product C. So again, pretty simple math and pretty simple, really, mechanics involved in this. But again, just two different methods, and they're going to probably end up giving us two slightly different results. In this case, they did. And that would be the question. This could be done a couple different ways, and ultimately management or whoever's looking at this could decide which would be the best indicator, or they could take something that's in between the numbers if it's not clear, or if it's clear that both would be good indicators, maybe something in the middle. But anyway, that would be some methodologies that would be used to allocate the joint cost. Obviously, the smaller the joint cost is, the less critical this is, but the larger the joint cost is, the more critical it is. So, in certain industries, for instance, in the oil and related product industry, the crude oil sometimes is a pretty substantial portion of the product. Some other chemicals where the processing and additives and things like that are significant, and can be traceable to the end product, maybe the base product, the petroleum base product that's used isn't as critical. And so it's not as big of a deal. But in some cases, it is more of a challenge. But again, it just depends on the type of business. So anyway, that's the rest of chapter 19, fairly mechanical type chapter, but again, can lead to, really drives potentially the accuracy of the costing of the product. And we've seen, as I said earlier, how that can be a huge issue relative to pricing in the marketplace, as well as a number of different strategies around pricing, and ultimately understanding that product cost will have a tremendous impact on how you run your business.